let's look at the stock exchange, one of the most important components of the stock market, in the following sections. A marketplace for stocks. In 1790, before there was an actual stock exchange, investors met every day under a buttonwood tree in New York City to buy and sell stocks. When this site got very crowded, the brokers and merchants moved their trading offices to a building on Wall Street, known thereafter as the New York Stock Exchange. Even now, when you hear the word Wall Street, it refers to our financial markets. There are other stock exchanges, including the NASDAQ, which was the first electronic stock exchange to run primarily by remote computers. There have been various other stock exchanges in the United States that have merged or been closed over time, and there are additional stock exchanges located in major cities around the world. All exchanges are predominantly electronic today, even though some still have trading floors. Fortunately, because of personal computers, you can trade stocks from anywhere in the world. This provides you faster, less expensive, and more efficient opportunities to build wealth. Competition is good for everyone. The more buyers and sellers that exist in any market, the better it is typically for both the buyer and the seller. If there are few interested buyers, it may be difficult to sell an asset regardless of price. If there are a lot of buyers, competition among them increases as they all compete for the best, lowest price. Similarly, if there are few sellers, it makes it difficult for buyers to obtain a decent price. When a lot of sellers exist, they too compete for the best, highest price. Competition among companies forces them to create more desirable products and provide them at lower costs, thus benefiting the end users. Public companies with unique products that people want may also find more buyers and sellers in the stock market for their shares. In the end, the competitive forces that drove the company to become more innovative may create a more competitive market for their stock. Furthermore, extra competition leads to better understanding of what a particular security may be worth, referred to as price discovery. If there are no interested buyers after all, it is difficult to determine what something is worth. The foundations of competition are based on the economic principle of supply and demand. Generally, the higher the supply and the greater the demand, the more competitive the marketplace. Lower prices and more efficient service. One of the smartest reasons to invest in the stock market is that it's relatively easy. Keep in mind that it's not necessarily easy to be profitable, but it is very easy to participate. In addition, stock market transactions are remarkably efficient. No matter where in the world you live, you can trade stocks. Because of computers and technology, transactions are completed instantly, behind the scenes, and there is always a buyer or seller for your stock. All of the brokerage firms have made it exceptionally easy to open up an account. You merely fill out and sign an enrollment form, send a check, and usually within a week, you'll be set up to invest in the stock market. The independent investor is born. In the past, your only choice for investing in the stock market was to go to a stockbroker. The internet, however, changed that. Now, even the largest, most prestigious brokerage firms allow clients to independently buy and sell stocks through the internet. You can buy and sell from the comfort of your own home. The drawback, however, is that you will not receive professional investment advice, but have to decide for yourself which stocks to buy and sell. Speaking of the stock market, many people are not content to let someone else manage their money. Perhaps you're the kind of person who wants to control your investments and is willing to do the necessary homework to find your own stocks. If you want to invest or trade on your own, then the stock market is possibly the best place for you to achieve your financial goals. On the other hand, Perhaps you're not interested in investing or trading on your own and want someone else to do the work for you. In that case, you might be interested in professionally managed mutual funds. The risks and rewards of mutual funds. After you open your investment account with a brokerage firm, you are allowed to buy and sell individual stocks, bonds, or other financial instruments. But you have another choice. Instead of investing directly in the stock market, you can buy or sell shares in an intriguing investment product called a mutual fund. We'll now consider the following: why mutual funds are a good idea, the risks of mutual funds. One of the advantages of mutual funds is that you leave the buying and selling decisions to the fund manager. If you don't have the time to choose and monitor individual stocks, the mutual fund manager does it for you. There are mutual funds for nearly every financial product, including bonds, fixed income, real estate, technology, gold, oil, and almost any kind of investment you can think of. The main advantage of mutual funds is that they allow you to diversify. Another way of saying you aren't putting all of your eggs in one basket. For example, if you had bought shares in the bankrupt companies mentioned earlier, you could have lost all of your invested money. But if you had bought a mutual fund that invested in one of those companies, you probably wouldn't have lost more than 3%. Another advantage of mutual funds is that they are a good way for new investors to become familiar with the stock market. Although mutual funds sound like a good idea, and they often are, they are still not perfect. Just like the stock market, there are risks when investing in mutual funds. For example, many mutual funds go down in price, sometimes more than stocks. Most mutual funds are designed to do well in bull markets. Therefore, they struggle during the bear markets. In addition, although mutual fund fees are generally low, they still cut into your potential profits. Although mutual funds have many advantages, it is also true that most fund managers don't outperform most market indexes each year. Not only that, many charge higher fees for this underperformance. That is why many investors choose index funds instead. Index funds are designed like mutual funds, but simply mimic the performance of specific indexes. Because you aren't paying for stock research and salaries, index funds usually cost less than mutual funds. And finally, although you can be protected from plunging stocks, the opposite can happen when a high-profile stock goes up a lot. Instead of the huge returns you dreamed of making, owning a stock in a mutual fund could limit your profits. Why? Because mutual fund managers invest in hundreds of stocks, diluting your potential returns. Some people want more control of their portfolio rather than leaving it in the hands of a mutual fund manager. For those who want to actively manage their investments, the stock market should meet their needs. Actually, some investors do both: invest in the stock market and keep a port on their portfolio in a mutual fund. The stock market summary. The stock market is a place for companies to raise additional capital for their business. It is also a place for investors to go look to enhance returns while assuming additional risk. When investing in a stock, you own that company and are entitled to certain things like voting for the board of directors and perhaps receiving dividends. Over time, the stock market has proved to be a place for investors to diversify and increase returns while incurring the risk of losing principal. Two popular ways one can invest in the stock market are by investing directly in an individual company or through mutual funds.